It's probably better for you not to do it.
Well, yeah. The way it is. Yes. It's good for you. You don't have to like it. Well, they have come up with some really good non-dairy ice creams, vegan ice creams. And our favorite, they ran out for like months. No store was carrying it. Now they're carrying it again. It's the So brand, S-O, and it's cashew milk.
Yes.
And it's
it's excellent.
And it's the cashew milk. It's the caramel chocolate cluster or something, or salted caramel chocolate cluster, and it tastes the closest to real ice cream that I've ever had without an aftertaste. Like the ones that are coconut milk based, strong coconut initial flavor, you can't get around that. And even the almond ones roll it off.
Edward Grant here. I'm sorry, it's Martin? Marty? Marty. Oh, hi, Murray. Yeah, sorry. Yeah, where are you right now? Oh, okay, yeah, I'm about to record a radio show, so put me in touch with the guy right now. So let me give him the credit card. Hi, it's Edward Brown. I'm gonna have to make this fast because I'm about to record a radio show. You ready? It's a MasterCard, and it's 559. Hold on a second. Let me. Okay. You ready? It's 5593-094. I'm sorry. Let me try it again. Someone was trying to call me. Okay. It's a MasterCard. It's 5593-0949-9043-2093. It expires 04/21. The 3-digit, the back is 304. 94901. Great, thank you. Okay. You guys are working my house.
Oh, God. Oh, for your house?
Yeah.
Your contractor?
Yeah, exactly. So, okay, so he said he's just wrapping up the call. He's going to call us right now. Okay, so I have your email question, which is, what differentiates your fund from other mortgage funds?
Yeah.
We're the best. We're number one. Number one, I tell you.
I've got a deal of the week, too.
Oh, good.
Finally. It's really more what the topic, it's really more what I can talk about using the example of the deal of the week. I can talk about a whole segment just about that alone.
Okay. Good. We'll get this guy on. Mileage points still worth it? How important are credit cards? Plug-in points for managed points more valuable? Trends are seen from the aircraft. Future airline. Okay. Okay, that's good questions. I like them. Yep, there we go.
Awesome.
Would this be Matthew?
Yes, hi.
Hi, Matthew. How are you?
Doing well. Sorry for the audio. Probably having the blow would not be a good background.
Yeah, that's true. So my co-host Mark Pont is here.
Hey, Matthew.
Hi there.
And if you guys are ready, because Mark has to catch an airplane, so we're going to get right in it, okay? So,
You have an intro for him?
What's that?
You have an intro for Matthew?
Yeah, I'm going to introduce him as Mathew Klint from Upgrade, and that's upgrd.com, who's going to teach us about frequent flyer miles, okay? All right, so Matthew, get ready, and when I introduce you, then you can say, thank you, Edward, and Marcus, I go by Edward,
I'll probably start out with the first question for you, Matthew.
Okay.
We may just go down your list. You got a great list of questions. Usually the questions guests provide us with, usually we just go right into it. We don't actually ever use them, but yours are pretty good.
Okay, so stay tuned. We're going to go right into it. Okay, here we go. Welcome. You're listening to The Best of Investing on Talk 910. I'm your host, Edward Brown, along with my co-host, Mark Hoff of Pacific Private Money, one of California's fastest growing mortgage investment firms. Our phone number is 888-912-1190. Use that number to answer the trivia questions for 3 vacations given away during this show. And those vacations are not sponsored by the radio station, but by Lighthouse Resort and Marina, located about 1 hour northeast of San Francisco. Those vacations are free. Their only request, a $100 cleaning fee to cover the housekeeping expenses. Today's trivia theme, since we're in baseball season, is baseball in the 1980s.
Nice.
You might find it some of this. Now, before we introduce our guest, I want to mention we have a special deal on the Best of Investing, and it has to do with paintball. So if you've never played paintball before, it's a lot of fun. Go to the Best of Investing website, and on our front page, if you click on the paintball banner, it's 85% off.
Wow.
Yeah, so
That's
you
a
get,
discount.
it's great. You get 6 all-day paintball tickets with equipment rental for only $30.
Nice.
And there's hundreds of fields across the nation. So check that out. Again, go to the Best of Investing website, check on and click on the paintball banner. Okay, so today's special guest is Mathew Klint from Upgrade, and that's spelled upgrd.com. And he's going to get into all the frequent flyer information. Matthew, welcome to the Best of Investing.
Hi, it's good to be with you, Edward and Mark.
Hey, so Matthew, I'm so glad you're on today. It's interesting. I've actually been thinking a lot about this topic lately. You know, you read and hear about frequent flyer miles that expire and are being discontinued. And so I'm actually really curious. Is the whole frequent flyer miles and points game, is that still worthwhile, and is it still an opportunity today?
In a word, yes, definitely. It's, let's be clear, it's not what it used to be. It was quite lucrative going back a few years. Now, not as much. And yet, it's still definitely worth your time to put in your frequent flyer miles and sign up for these programs to fund top of them.
Now, the one area that I know that people that I know who are still using it use it. They're collecting frequent flyer miles through credit cards. Is that still an effective way to grow your frequent flyer miles points, and are some cards better than others?
Yeah, especially for those of us who don't fly often enough to get premier status.
Right.
Absolutely. I mean, you don't even need to fly much to collect a whole ton of miles. And that's the thing. I mean, when you fly, actually, if you're buying economy class fares, you're earning less miles today than ever before. And to switch to a sort of a revenue-based way of awarding points, I don't even know why they call them miles anymore. Not based upon miles flown, they're based upon dollars spent. But with credit cards, you're still earning 1 to 2 miles per dollar, and that presents great opportunities to earn a whole lot of points fast, especially with lucrative sign-up bonuses, especially, if you run a business, you put all the business expenses on the credit card and pay for all the company travel.
So I used to have an American Express card with Travelocity because I used them in the past. And the thing that was good about it was if you hit 20,000 points, you get 2 cents, basically 2% towards any stuff you use for hotels or flying or cars. But they got rid of that, and now Barclays has the MasterCard, and it's only worth a penny a mile. They give you double points for travel, but it's not quite as good. Is the best out there about 2 cents a mile?
It is, but yes and no, and let me explain. If you're just looking, to go when you want at the time you want, usually buying economy class tickets, the cards like that probably are going to be best for you. They're not, I wouldn't consider them lucrative, but they're fairly good, and they do help. But if you're the type of traveler who's looking for the first class, business class, long haul redemption, premium redemption, then those sorts of cards are the wrong cards for you. What you want to focus on is cards in which you can either bank directly or transfer to airline programs. Airline programs have award charts, and they tend to be more lucrative for these premium long-haul travels. And let me just give you an example. Let's say you have the Capital One card, like the card you spoke of. You get 1 cent per point or twice on travel. So let's say you want to go to London. Let's say you want to fly business class, about $8,000 for a full fare ticket of business.
Yeah.
Okay? And so you use those Capital One points to pay for that ticket. You're going to need 800,000 points. But let's say instead, you're using a United Explorer card. United is hubbed in the Bay Area, San Francisco hub. If you can find safer space, and let me give this disclaimer, it's not going to be available every day, but flexible in travel, you can look for that ideal day. You're going to be paying 115,000 points instead of 800,000 points. Quite a difference.
So you're saying from like an airline affiliated credit card would be fewer points?
Correct. Yeah, when you're using these sort of generalized cards that only give you 1 cent back on travel, then you're essentially going through their travel agency to book. They just apply 1 cent off the cost of a revenue ticket.
Okay.
And that is just not very valuable. And when you have airline points, then the way the airline has their award chart, it makes the premium cabin redemptions a much more valuable deal.
Okay, so for someone like me who doesn't travel a lot, one of the problems I had with companies like United was I could never use my points because it was always blacked out or saved for more frequent travelers. Is this different then that you're talking about?
It's always an issue, but there's ways around it. I mean, if you have to fly on a nonstop flight a certain day, then that's not best for you because that is tough to find on United or on Delta or on American. But if you're just a little bit flexible, if you're willing to make 1 stop en route or 2 stops, or if you're willing to go a day earlier or a day later, chances are you can find the space you want much, much cheaper than using those Capital One or Travelocity cards.
And is that where you come in, where somebody would call you and you'd arrange that for them?
Correct, yeah. I offer a consulting business on effectively using credit card points and frequent flyer miles at awardexpert.com, and so that's my day job, is just helping people do that. And yeah, I mean, you can do it yourself. It's not rocket science. I mean, I'm certainly there to help. There's other companies who do the same thing, but all you need to do if you want to do it yourself is just put in the time, put in the effort to take a look, pick up the phone and call, because what you see online is not always best available.
Yeah, and the thing is, a lot of us are busy and we don't want to deal with that. So what do you charge for your service?
I charge $150 for the first passenger and then $100 for each additional passenger.
Very reasonable.
Do you also recommend a specific credit card to use, and is it based on a client's airline preference, or do you typically like one or more certain airline-based credit cards?
No, that's a great question, and we do actually offer customized credit card consultations as well. But I just spoke earlier. I spoke of the things with airline credit cards and airline programs, but actually the best credit cards to use are these credit cards like the Chase Sapphire card or an American Express Platinum or Gold card, in which you earn these points which are transferable to multiple programs. American Express partners with more than a dozen airlines. So you build up these points in this account, and then you can transfer them to whatever airline program makes sense for you. Same is true with Chase and their Ultimate Rewards program. That's the credit cards that I use daily and that I keep in my own wallet.
And I've been using, like Southwest has a Chase card. And the thing I like about it is the points system is pretty decent for that one.
Yeah, I mean, for those who, they just want to fly domestic or a lot of inter-California flying, Southwest, of course, is a great carrier. And, again, I don't use the Southwest card just because I like using my points to, fly overseas in business class. The Southwest doesn't help with that. But, if that's not your thing, Southwest is great. And, gives you sort of flexibility to get on the flights you want at a reasonable redemption rate.
So, how do you see the future of these airline points, so-called loyalty? What's that look like?
Interesting. I've flown over 1 million miles on United, and I've been loyal to United for over a decade now, and we've seen it, not just at United, it's at all the legacy carriers. We've sort of seen this great transformation, which loyalty used to be rewarded sort of on a long-term basis, where if you're loyal to us on a consistent basis, we're going to give you an upgrade. We're going to help you out. And we're really seeing that change. We've seen it change in the last few years. We've seen airlines embrace more transactional loyalty model where they're going to say, what have you done for me lately? And so the way that manifests itself, business class fares are way down. So, you're traveling domestically, and it used to be like, want to buy a first class ticket to New York or Chicago, it would be 8 to 10 times the price of an economy class ticket.
Yeah.
Now it's only about double
Oh, that's not bad.
times.
Wow.
And so it's made getting into a premium cabin a lot more affordable for a lot of people, myself included. The flip side, though, is that because people are buying all these tickets directly into first or business class, then you're not really seeing a lot of upgrades anymore.
Interesting.
So those passengers, who've been loyal to a carrier and are sort of accustomed to getting upgraded, that's really not happening anymore, and I don't see that changing at all in the future.
Yeah, because it's good for the airline because with credit card, they're charging the merchant probably close to 3%. They're only giving 1 to maybe even 2% back, so they're making money on that. They're not doing it for free.
Absolutely.
So Matthew, how do listeners get a hold of you and find out more about how they can leverage their mileage better?
Well, you can check out upgrade.com, upgrd.com, and that is a blog that I write and participate on. It's about a dozen writers. We provide up-to-the-minute airline news on effectively using your points. And then my own business, it's awardexpert.com, a consultant service. Again, happy to help both individuals and companies effectively use their points and miles.
So that's Award Expert, not with an S on the end, right? Awardexpert.com?
That's correct.
Okay.
All right, Matthew, thank you again for joining us on The Best of Investing.
Thank you very much.
All right.
Interesting.
Very cool. Very cool. Always like to learn about these freaking flyer.
You have to check out those websites. Upgrade.com, upgrd.com for a blog on information on how to leverage your points and mileage awards, or go to awardexpert.com for Matthew's own consulting services on how you can get cheaper tickets and upgrade.
That's right. Okay, we're going to cut to our first commercial break. Before we do, I want to make a quick little announcement here. Join Sail Now for a day of sailing on the beautiful San Francisco Bay. You can also enjoy a picnic on Angel Island. Check them out at sailnow.com or call 650-619-6896. All right. And let's see. Here's our trivia question. Baseball. We're talking about baseball.
Yes, indeed.
In the 1980s. All right. Who was the National League home run king in half the seasons of the 1980s? All right. The first caller with the correct answer is going to win a free 3-day, 2-night stay at the Lighthouse Resort. Call 888-912-1190. Don't touch that dial. We'll be right back.
Half the seasons of the 80s.
Yeah.
Is this a trick question?
No, I mean, you'll know the player.
Drawing blanks. My ball players.
So Debbie says we're getting paid off on the Yip Quartet loan.
Oh, the Yip loan?
Oh, the Yip loan, yes.
The Yips.
Yeah, get the Yips.
Yip.
For Wine Garden.
Mm-hmm.
We'll get right into you.
Welcome back to The Best of Investing. I'm Edward Brown, your host, along with Mark Hahn, president of Pacific Private Money. We cut to the first commercial break. We asked this trivia question: Who was the National League home run king in half of the seasons of the 1980s?
I'm just going to guess Barry Bonds because I can't remember any of the names. I was tipping my tongue.
There was a third baseman for the Phillies, Mike Schmidt.
Mike Schmidt. That wasn't even on my radar.
Big home run
Wow.
hitter. So I wanted to make a little mention here for the Weingarten Children's Center. So imagine your child cannot hear or speak. What do you do and where do you go? You go to the Weingarten Children's Center. Check them out at listenspeaklearn.org. Okay, so Mark, you have a deal of the week for us. Let's just get right into deal of the week.
It's been a couple of weeks since I've shared a deal of the week, and why I want to share this one is not so much the deal itself, but what it's indicative of in terms of the conventional mortgage industry. Conventional mortgage includes one you get from a bank, and sometimes we refer to it as bank financing, but the fact of the matter is that most people who get a mortgage don't actually go to a bank. They call a mortgage broker, and they get a conventional mortgage through a mortgage broker, which may end up being through a bank. It may be a Wells Fargo-based loan. In fact, I just got a home loan for my house through a mortgage broker, and they immediately turned around within 30 days and sold it to Wells Fargo.
Oh.
So I've got a Wells Fargo home loan, but I never walked into the branch. So that's typically how it's done. So we got a call last night. Not last night. We got a call this week, Wednesday night. And so it's Wednesday night, get a call from a broker who sends me a lot of business, and he says, I just got a call from a realtor who has a transaction that's about to maybe go bust. And it was supposed to close this week, Friday. So Wednesday night, I get a call. They've got an escrow that's supposed to close on Friday. The borrower has had an approval from Wells Fargo, coincidentally, to do the loan. And last minute, a glitch came up, and the bank was not going to be able to accommodate the loan request.
What was the glitch?
Now that's it. I don't know what the glitch was.
Okay.
So, but I do know that we have done hundreds of loans over the last several years for all kinds of situations. And so what I want to talk about is the fact that more and more and more, and especially now in 2016, we're seeing transactions that in the last minute will glitch. A higher percentage, now it's still a small percentage of total transactions that happen, of the thousands and thousands of transactions that happen in the Bay Area alone, let alone in California or the United States in total. The vast majority of people who get a funding commitment are able to close, but there's a growing percentage, and they don't keep statistics on this, so I really don't know what that number is. I know it's growing because everybody says it is. Anecdotally, everyone says, I've never seen as much fallout, and this would be conventional mortgage brokers are telling me this. They've never seen as much fallout as they're seeing now. They're never seeing as many failed transactions as they are now. And the reason they are seeing more failed transactions is this thing we've been talking about on this show for years, which is the effect of layer after layer after layer of new regulations under the Dodd-Frank financial banking reforms. Now, and when I say layers, I really do mean layers, because they first, it's 2008, we have Lehman Brothers collapse, which leads to the entire financial markets on the precipice of a global financial collapse. And as early as 2010, they started to make reforms in the form of regulations, stricter lending guidelines that now banks and conventional mortgage lenders and even private money lenders like Pacific Private Money have to adhere to. And every year since 2010, including just this past January of 2016, every single year they've added more regulations, more things you can't do, more restrictions, more people you can't make a loan to, more situations, borrower situations that are now considered predatory in nature.
Go government.
Now, don't get me wrong; these were all done by, we're from the government, and we're here to help, right? So the problem is that when does the government ever pass a law when there's not unintended consequences? And the unintended consequences of Congress attempting to swat those predatory lending banks and bad actors in the mortgage business, those people that were making loans to people who couldn't afford them, those who were making loans to people that they shouldn't have been making, those who were assisting their applicants or actually lying on behalf of the applicants on the loans, all that nasty stuff that was going on. So they create all these regulations, layers and layers and layers to try to prevent that from ever happening again, to prevent the type of credit bubble that almost brought the world financial markets to its knees. So that's it, right. That's a good thing, right? You want that in some way. But the unintended consequences are that people who should be able to close on a funding request more and more and more, a larger percentage. Again, I don't know if it's 5% or 10%, but let me tell you, it's growing. A larger percentage of transactions are not being completed because of things that pop up. One of the main things is just simply that people are finding out, particularly if you're self-employed, and a super high percentage of Bay Area applicants are self-employed, or a portion of their income when they're two earners is from self-employed income. The banks really look hard on that now, and it's really hard to have all of that income, or even a significant portion of it, recognized by the bank in their calculations to determine debt to equity ratios. And so a lot of people who make really good money and can easily afford the loan they're applying for are being turned down. Now, a lot of times that happens up front. The shock is, they decide they want to, move up or move down. They want to get a different house, and they go and they talk to their conventional mortgage broker to find out what kind of loan they qualify for, and they find out that they don't qualify for nearly as much as they believe they should be able to. And in fact, they couldn't even repurchase the same house with an 80% loan that they're living in right now because of the new lending restrictions. They may have gotten a loan years ago that they could not actually qualify for today, no thanks to those new lending restrictions. So, and that drives people to companies like Pacific Private Money. So when someone says to me, and I get this question every day, Mark, I don't understand your business model. Why would anybody borrow money at 10% when you get a bank loan for 3.5% today? I mean, we're at an all-time low right now. This past week, we got another record low in mortgage rates. Who on God's green earth would come to you? Well, let me just tell you, a lot of people find themselves, not because they want to come to a company like Pacific Private Money, but there is no other plan B. Plan A is go to the bank.
Well, I just heard of a situation recently where this guy wants to buy an apartment building, and he, in order to beat out 15 other bidders on this property, he gave a 10-day no contingency close. There's no bank in the world that can fund in 10 days.
Right, and so a lot of people come to us for speed. I mean, that's the number one reason people come to alternative sources of financing like Pacific Private Money. When your realtor says, well, your only option is a private money loan or a hard money loan, that's what they mean. They mean you need to investigate the alternative real estate funding sources offered by companies like Pacific Private Money. So we just talked about one area. Well, you mentioned it too, because speed is one, but also just finding out that your income no longer qualifies. But you could probably do something over the course of the next 6 to 12 months to make yourself look better to a bank loan, but you want to buy now. So that's another situation where you might go to a private money lender to go ahead and get the transaction done. Pay more for the money, but you get the transaction. The third one, and this is the example that we had last night when I got a call from this guy who says, they had a Wells Fargo approval. They're already gone beyond the contingency period. Their deposit is now non-refundable. They call it going hard in real estate. And
that means because it's hard to get your money back.
That's right, really hard to get your money back, not impossible. So their deposit is now non-refundable, and they just found out last minute that the bank goes, oops, we're not going to be able to make this loan. There are actually a lot of things that can happen in the funding process, and we know that escrows now are longer than they were historically. They're up to about 45 days on average now, because that's about what it takes to comply with all the
It might be something as simple as the appraisal's been approved, but it needs to go to the review desk and the review desk is 1 week behind.
That's happened, and that's a delay. So delays sometimes can cause, the seller might say, I am not giving another extension. I don't care what your bank says.
Yeah.
Close by Friday, or I'm keeping your $50,000 and going to the next guy. That's one. Another one is, in an extended escrow, oftentimes the bank will pull credit again, and sometimes your credit score changes, and now you don't qualify under that particular program, and now you have to be re-underwritten, which also causes a further delay. That happens quite a bit.
Here's something really silly is, like I've gone into something as simple as like Home Depot, and they are basically giving you a deal that says, if you apply for a Home Depot credit card, we'll give you 15% off of your purchase that day. And you're thinking, great, I got to just, sit
Most
around
department stores offer the same thing.
Exactly. So you sit around for, 5 minutes or so, and they pull your credit, and they do a hard pull.
Yeah.
And when you do a hard pull, your credit score drops, 4 points?
Yep.
And so, that may be the difference between getting a loan or not getting a loan.
Yeah, sometimes a lien pops up. There's just a lot of things that can happen, and it's just, this is a new world that we're living in when it comes to getting conventional financing. Conventional financing is much more difficult to obtain than it was. Now, there's still, like we've got Rob Spinoza here, a co-host from RPM Financial, who's excellent at his job, but even he can't prevent some of the glitches that happen in the transaction. Again, that's why we exist. That's why companies like Pacific Private Money exist. Dodd-Frank, for as much as I hate it from a conservative and libertarian perspective, it's actually been a boon to the business model of alternative real estate financing sources like Pacific Private Money. So for more information, if you're a realtor, if you're a mortgage broker, or if you're just someone who has learned the hard way that you don't qualify for the type of financing, or if you're really, you've got an opportunity to buy a property or a home, and you're told you can't finance it conventionally, or maybe you want to make an aggressive offer because you're tired of losing out on all the offers you've been making because you're making conventional finance contingent offers. You want to make basically as good as an all-cash offer. Come to Pacific Private Money, and we can help you with a no contingent fast close in 14 days. Is it expensive? Well, compared to what? Compared to not getting the property, compared to not closing, compared to losing your non-refundable deposit. So, call us, and we've got a lot of different loan programs depending on the situation. The easier the transaction, we can work with you on the fees and costs. But generally speaking, you can expect the note rate to be around 10%, and the origination fees, which really help us. We keep the origination fees. Our investors get the interest rate. That's kind of how it works in private money. So the origination fees are going to be between anywhere from maybe 1.5 to 4, depending on the size of the loan, the speed, and other complexities. But check us out. PacificPrivateMoney.com is the easiest way to find out about our company, and all our contact information, email addresses are right there. PacificPrivateMoney.com.
Or 415-883-2150.
That's right.
Okay, we're going to cut to our next commercial break. Before we do, again, let's make a quick mention here for the paintball tickets. So you can buy 6 all-day paintball tickets with equipment rental. You get all-day admission, rental, and safety equipment is included. The tickets never expire, and you can use them in individuals or with groups. Valid at hundreds of fields nationwide. It's normally $210, but with the best of investing, you go to our website, you click on paintball, it only costs $30. That's 85% off. So go to the best of investing website and click on paintball. All right, here's our next baseball question. What Phillies slugger, upon seeing Lake Michigan for the first time, asked, "What ocean is that?" Not Yogi Berra. All right, the first caller with the correct answer, he didn't play for the Phillies. The first caller with the correct answer was a free 3-day, 2-night stay at the Lighthouse Resort. Call 888-912-1190. Don't touch that dial. Best of investing. We'll be right back.
2 long segments there, so it looks like Matthew said, "Thanks, are we done?"
I saw that too. Well, when we don't get back to him, I guess he'll figure that we're done.
That's funny.
Should have told him to be a little more animated. It's a little bit too, That's okay. It was a very reasonable price, $100, $150.
Yeah.
Help out.
Oh my God. Tim Witcher passed away.
Who's that? Who's Tim Witcher?
Leonard. Who's Leonard? I don't know. Wow.
Who's Tim Witcher?
If you don't know him, it's a long story.
Oh.
Yeah.
But in the business or
Yeah, he's a conventional broker.
older guy?
No, our age.
Oh my gosh. All right. You get into email time and you can talk about the fund.
Yeah, let me just, I don't know why I started doing this.
What's that?
Yep.
Welcome back to the Best in Investing. Again, I'm Edward Brown, your host, along with Mark Hunt of Pacific Private Money. Second trivia question. What Philly slugger, upon seeing Lake Michigan for the first time, asked, "What ocean is that?"
I have no idea.
Okay, you see him on TV now. He's a commentator. John Kruk.
Oh, okay. How do you know all these? I don't even know who these guys are.
Oh, you know John Kruk. Remember, he was the guy when Randy Johnson pitched in the All-Star game and almost hit him in the head, and he just kind of backed out.
Oh,
Yeah,
okay.
he's a funny guy. All right, so Mark, we have an email for you. It says, what differentiates your fund from other mortgage funds?
What differentiates the Pacific Private Money Fund from other mortgage pool funds? There's just, where do I start? That's actually a really good question. It's a great question. We get it often at our monthly fund presentations that we do at our brand spanking new offices of Pacific Private Money, located in the banking district in downtown Novato. Novato, of course, is in North Marin, right off 101. Every month, usually the last Wednesday of the month, we're doing a basically 30 to 40 minute presentation. We've had anywhere from 10 to 20 people show up. We have hors d'oeuvres and drinks, and it's Edward and I, and a little slide deck on our PowerPoint presentation. We kind of go through the fund, why we exist, why a mortgage pool fund, why people should seriously consider investing a portion of their savings and retirement funds into an alternative investment strategy like a mortgage pool fund in general, and in particular, why we think the Pacific Private Money Fund is a superior design in the mortgage pool fund category. Why is ours better? So, when we designed the fund, initially I knew I wanted to have a mortgage pool fund as a source for making loans for years. Usually when people start out in the private money loan origination business, so when I started this company in 2008, I used high net worth individuals to fund my loans, and probably for the first nearly 1,000 loans that we did over the course of several years. That was really our only source of funding, and our only source of capital were high net worth individuals who like to invest in mortgages, real estate secured notes. In order to scale and grow your company, which was always on my mind for Pacific Private Money, we knew that we would need eventually to be able to create our own fund where investors could come and deposit their money and make passive investments, where they're not actively pursuing individual notes, but rather letting us do the underwriting and make the funding decisions. And again, it's a pretty common practice throughout the industry, but it does take some credibility, some means, and you have to have the right attorneys and the right consultants. And what I found is when I investigated attorneys, basically securities expert attorneys, and questioned them about them, we met several of attorneys who said that, oh yeah, we could do a fund for you, no problem. We could put it together for you. We know all the regulations, etc. But then they would ask me, so how do you want to structure it? What do you want the so-called waterfall to look like? Which is a combination of what preferred return do you want to do? How do you want to handle the fees and et cetera? I mean, there's just a lot of decisions to make. And the thing is you've all heard the saying, you don't know what you don't know. And I didn't know what I didn't know. So all I knew is I wanted to create a mortgage pool fund and begin the activity of capital raising for the fund. And it was 2012 when I started this process. And I met this company called Fairway America out of Portland, Oregon. In fact, I'm going to be visiting them soon. And they were in the business of consulting to companies like ours to help us decide how to create a mortgage pool fund, how to design it basically, how to financial model it, how to design it. And so, again, you're taking a long time to answer the question, why is the Pacific Private Money Fund, how is it different, and why is it better than other funds, how does it compare to other funds? And so Fairway had 7 funds under their belt before they decided to engage in the practice of consulting to other private loan originators and help them design funds. And they've been very successful at it. In fact, they've done over 150 loans to date.
And they did funds, 150 funds?
Different funds, throughout the United States. And so so I met with them, several meetings in fact, and engaged them, and they had their own, their preferred securities attorney as well. So but it was the whole team concept of putting together the different decision points. And so what we were looking to do, and this was very important to them, is how do you create an alignment of interests between the people putting their money in, the investors, and the broker who's deciding on which loans to fund. And that's really, it's very important. And one of the things we do that a lot of fund managers don't do is that we put half of the origination points on every loan that we do into the fund, along with 100% of the note interest income. So the fund gets all of the note interest income with no deduction for servicing. I provide that as a fund manager as part of my fund manager fee. But I also put half the origination points. Why half and not 100%? Well, the other half goes to pay our loan agents. So it's paid out in the form of referral fees and to our independent loan agents who work on all of the deals. So the house share, which is 50%, which is basically my share if I'm the broker, that's going into the fund as income. And why is that a good thing? And why is that an alignment of interests? Well, one of the accusations oftentimes to a fund manager is, well, how do I know you're not monkeying around with maybe the interest rate and the points? Maybe you offer a lower interest rate in return for higher points, knowing that the fund gets the interest rate, but you, the broker, get the points. And so that was a common practice and may still be, in fact, among fund managers when you're looking at maximizing your own personal income. So again, it's just it's an alignment to keep the goals for the fund manager, and that's just one of several areas. Another is that we use third-party fund administration. Fairway America is also our fund administrators, meaning that they do the accounting and they do the reporting to the members of the fund, the shareholders, every month. It's just not all coming from me. Now, I write a monthly newsletter as the fund manager, but it's not it's not just you taking my word for it. So again, it's just one step again that we do to prevent, to at least give peace of mind to the shareholder that no, this is not a Bernie Madoff situation. You're not dealing with a family or a person who has 100% unfettered control with no oversight. Another thing we do is we have an annually audited return. So we've got one of the top auditing firms in California who audits more firms than more mortgage pool funds than any other accountancy in California. So there's just a number of things we do.
A lot of oversight.
A lot of oversight, and that's the main thing. One of the questions we get when people consider investing in our mortgage pool fund, is how do I know my money's safe? And so we go through all of these various safety and security features that we built in to the fund model and the way we do business. So again, and our fund has been paying. We've just passed our 36-month mark. We've been 36 straight months of paying just a little over 8% on an annualized basis. We do distributions every single month, and we distribute more in 1 month than most banks distribute in a year.
Yeah.
More than you can earn in a money market account in 1 year.
Yep.
Our average monthly distribution is 0.7%, nearly 3/4 of a point, just on a monthly basis, which averages out to a little over 8% it goes up anywhere between 6.7 to 6.8%, 0.67, 6.8 to 0.75.
Well, the other part about being conservative is the fact that you record your loans on the title report, so that if anybody were to go to the addresses of the loan portfolio and pull a preliminary title report, they would see the Pacific Private Money Fund in first position, or second if you did it second.
Right, we behave just like a bank, just like a conventional lender. We don't do escrows in-house, and some companies do. I would be very uncomfortable as a custodian of shareholder monies to try to explain why it is we're doing escrows in-house. We, in fact, use top companies, top nationwide companies on every single transaction. We never close a loan that isn't funded through a national title company like Fidelity National Title, like Old Republic, like First National. What was that? It's on my tongue. Anyway, there's a whole bunch of them out there, and every single loan is insured by a title insurance policy. Typically an Alta lender's title policy. If you don't know what that is, give us a call. We're happy to share with you all of the various, and there are a lot of them, safety and security features that protect your money. And mortgage pool investments and trust deed investments have been called one of the best kept secrets in investing today. And it's not as much a secret as it was 5 years ago or 10 years ago, because more people are discovering that their neighbor down the street has been earning 8% or more on their money. We've got quite a few Bay Area investors that are enjoying fabulous secured yields through the Pacific Private Money Fund. So for more information, of course, just go to our website, pacificprivatemoney.com, or call us and leave your name and number, and we'll give you a call next week, 415-883-2150.
Excellent. Okay. And if you want to earn over 8% on your money, give Mark a call. You are still taking more clients, right?
Absolutely. We are in full growth mode for the Pacific Money Fund.
You passed the $17 million mark.
We did. Our goal is $50 million, and so we'll see. I really don't know how long it's going to take us, but we had a fabulous June. We actually collected over $1 million in new fund investor capital in the month of June. So
very good. It's placed it all out there. Okay.
Absolutely.
Here's our third and final trivia question. On baseball, we're talking in the 1980s. Who signed with the Yankees in 1980 for over twice the amount that George Steinbrenner paid for the franchise? Those franchises are now worth a lot, but who was that Yankees player? And again, this is somebody who you will be familiar with. Call 888-912-1190. If you're the first one, you'll win that 3-day, 2-night stay at the Lighthouse Resort. Don't touch that dial. The best of investing. I'll be right back.
Right, that was also a little bit of a long segment.
Yeah, so we should do a short one.
Yeah, 6 minutes and 11 seconds.
What? You figured that out that quick?
Yeah, because I did it at an even number.
Oh. 6 minutes and 11 seconds.
Yes.
All right, what do you want to talk about for 6 minutes and 11 seconds? Let's talk about the market, a little bit, the real estate market.
All right. And you're going to Fairway this weekend?
Yeah, and then Fairway has their conference in 3 weeks.
Yeah, I've got it all down. When you're up there, ask them if you would. We've talked about the 6% thing, and you've got some questions about making sure that you'd still be able to make a certain amount. Why don't you run that by them and then ask their advice as to how they would feel best to structure, what would they need to do structure-wise for it to be comfortable for you.
Yeah.
Okay. Ready?
Mm-hmm.
Well, welcome back to the Best of Investing. Last time for today, I'm Edward Brown, your host, along with Mark Hahn. Who signed with the Yankees in 1980 for over twice the amount George Steinbrenner paid for the franchise?
I'm totally striking out because that's the third one I'm not going to be able to guess.
Striking out baseball.
Yes.
Dave Winfield.
See, I didn't know that guy either.
You don't remember Dave Winfield?
No,
He played for San Diego, and he played for the Yankees. No.
You know, my brother's the guy that knows all these sports guys. There's just you got to be a certain type of person to like remember all this stuff.
Yeah, we are talking 30 years ago. Okay, actually 36. Okay, so Mark, we have a few minutes left. You wanted to get into a little bit of the economics.
Yeah, not so much the economics, but the what's the market doing right now, and not the stock market, because we all know what the stock market's doing, and that's like a big fat nothing, right? I mean, let's face it. You know, it's we're into July now, and if you look at July from 2015 through July 2016, the stock market is basically up zero year over year. The trailing 12-month return of the S&P, the Nasdaq, and the Dow are all zero or slightly negative. The Russell, in fact, is negative. And if you're an international investor and you've got any exposure in any of the foreign indexes, you know what negative feels like, because that's where you are year over year for that part of your portfolio. You know, so you know what's happening in the real estate market. Is real estate still a good investment? And you know, of course, we've been talking for years about the appreciation rates and when are they ever going to slow down? Well, you know, we follow Case-Shiller quite closely because it's one of the more reputable sources of where prices are going. Now, this is a trailing index because the report that came out at the end of June represented the month of April. And I'm not looking at nationwide numbers because, quite frankly, I don't really care about nationwide appreciation statistics because it's such a blended rate, it's almost nominal. I mean, by the way, it's 5%, okay, whatever that means. We care about what California does, and more specifically about what the Bay Area is doing. And the San Francisco Bay Area over the last 6 months has gone from 6 months ago, November, 11% on an annualized appreciation rate for November. The month of April, we're at a low of, I think it's like a 3-year low in terms of appreciation. It's down to 7.8. We're no longer in the top 3 and not even in the top 5. In fact, we've fallen to number 6 nationwide in terms of those cities, those metropolitan areas that are the fastest growing in the country right now.
It's still appreciating. It's
still appreciating. It's slowing down, which is a good thing because year over year double-digit real estate price appreciation is not healthy. It's not sustainable. It doesn't help people to get into homes. Yeah, well, it's good for sellers, but if you sell, unless you're moving out of the area, you got to buy something else. So it's not necessarily good for sellers unless you're moving to Texas. I'm certainly not going to do that anytime soon. So yes, we've gone from 11. I'm just looking at the last 6 months. 11, 10.3, 10.5, 9.3. March was 8.5, and April was 7.8. So we're approaching a healthy, normal market, and I think the target, if you were to ask me what I would like to see the appreciation rate in the Bay Area, I like that number 5. That 5% national number, is obviously a blend of fast-growing companies like Portland and Seattle area, which are at 12% right now. Denver too. Denver, Seattle, and Portland are the top 3 appreciating cities right now. So now, don't try to be a market timer. This is old data. Don't run up there and try to buy real estate and hope that's going to go up. This is what's happened in the last 12 months as of a couple of months ago. So we all know if you try to chase those high appreciation rates, oftentimes you're met with dismay. So good thing. I think we're in a healthy market. We're seeing a slowing down. Multiple offers are slowing down. We're seeing fewer multiple offers. The high end of the market is slowing down considerably. I know some of the wealthier markets like, Mill Valley, Silicon Valley, Southern Marin in general, San Francisco, the high end of the market above 5 million is starting to see a slowdown. So it's a good thing.
All right. So again, if people want to either need a quick loan from you or they want to invest and earn over 8% secured by Bay Area real estate, how do they get a hold of you?
For borrower clients and potential investor clients, PacificPrivateMoney.com, 415-883-2150.
All right, we're going to cut out here. Here's our thoughts for the day. Don't run away from challenges, run over them. I like that.
Yes,
and Derek Jeter, a Hall of Fame.
I know that name.
Yeah, I know that name for the Yankees. He will be inducted in the Hall of Fame.
Yeah.
There may be people who have more talent than you, but there is no excuse for anyone to work harder than you do. That is true. And don't forget, again, go to the Best of Investing website and click on the paintball icon for a fantastic deal, $30. You get 6 all-day paintball tickets. That's an 85% savings, and it includes the equipment too. So not a bad deal. All right, we wanted to. You have the investor, the clients, the listeners. Let's try that again. The listeners, tune in next week to the Best of Investing. We're going to be giving away more free vacations for answering trivia questions. Thanks for listening. On behalf of our team, I'm Edward Brown. We're wishing you the best of investing. So long. And she'll get that right. All right, catch your plane. Catch your plane. The plane.